What is an investment mandate? When it comes to investing your hard-earned money, don't leave anything to chance. Find out what an investment mandate is, why you definitely want to have one, and how it helps buttress your overall financial plans. After watching this video, you'll get a fuller, better picture of the whole investment process and understand what you're getting yourself into the next time you speak to an investment advisor or financial planner. Learn also about the various types of investment mandates and whether you need one. Welcome back, folks, to another edition of Sweetie Kiwi. How are you doing today? I'm doing fantastic if you were to ask me. If you are doing as wonderful as I'm doing, go grab a cup of coffee or tea or vodka and let's roll. So today I want to talk to you about what an investment mandate is. What is it? An investment mandate is an instruction to manage a pool of capital using a specific strategy and within certain risk parameters. The mandate will vary depending on the goals the owner has for that money. Investment mandates play an important role in managing pooled funds, so they may include instructions on priorities and goals, benchmarks, acceptable levels of risk, types of funds to either be prioritized or avoided, any other guidelines for how assets should be managed. Mandates can be used for private investors working with financial planners or for funds managed by professional managers. Index funds have investment mandates. So do exchange-traded funds, the ETFs you heard about, and university endowment portfolios. Whenever they're used, mandates direct the managers of these investments and help guide their decision-making. So you also can have an investment mandate as a retail investor. There are several names for investment mandates. Sometimes they're called just mandates or fund mandates. So that's the definition. So it's just a collection of things, of instructions that you put into a document so you can help the portfolio manager know how to allocate the funds. How investment mandates work. So whether they're used by private investors or the managers of large funds, investment mandates work by laying out the parameters for how a manager can allocate and invest capital, right? I already said that. The manager must follow the guidelines laid out in the mandates when choosing assets to buy, sell, or hold. Let me give you an example. Let's say a client approaches a wealth management firm with $1 million. The client wants to use the money later that year and wants the funds to be kept safe until then. The client is laying out a particular mandate to preserve the capital rather than risk losing it in order to grow, and that's known as capital preservation. Now, for the portfolio manager, there are a few options available. He or she cannot invest in stocks. We know that because stocks are too volatile for capital preservation, even if they would be suitable for a different mandate. For example, shares of a firm such as Microsoft, one of only 4 S&P 500 components with a AAA bond credit rating, should be worth considerably more money in 10, 15, or 25 years. But in the short term, they could be worth less, which will not preserve the client's capital. So the wealth management firm in this scenario can then tailor the client's portfolio to the mandate, seeking capital preservation within a short time frame with low risk, low volatility investment and cash holdings. Investment mandates are also used by the managers of large funds to guide how they choose the securities included in their funds. For example, if a fund has a mandate to offer investors as much potential growth as possible, they will invest in high risk, high reward stocks rather than in a mix of stocks and bonds. Now, investors in the end often choose where to put their money based on the fund's mandate. So the next time you are searching for a fund to put your hard-earned cash in, make sure that you read the mandate. You want to read the fund's mandate, understand what's really going on there, the instructions that investors have put into the original investors have put forth, or instructions or guidelines that the fund itself has written. I'll be right back right after this. Don't go anywhere. Welcome back, folks, to another edition of Sweetie Kiwi. We're also having a conversation here around investment mandates. Now, let me talk to you about the types of investment mandates. I've explained to you how they work, what the basic definition was. Now, if you love this kind of content, you appreciate the clarity and quality of the content so far, please consider subscribing to our channel so that you don't miss any future show release. We release this kind of shows every single day. And turn on the notification bell, please. Also, share, comment, and like this content. What are the types of investment mandates? An investment mandate can restrict a portfolio manager to a specific asset class, to a geographic area, an industry, sector, valuation levels, market capitalization, and more. A small capitalization stock investment mandate means that you, as the portfolio manager, needs to find attractive firms that are below a certain market capitalization size. A low turnover investment mandate usually means restricting the percentage of the portfolio that can be sold in any given year to 3 or 5%. So it has to be low turnover. A global investment mandate means that you should own stocks both in your home country and abroad. An international investment mandate restricts the portfolio to firms headquartered or doing business mostly outside of your home country. Let's talk now about a long-term growth mandate. This kind of mandate prioritizes the long-term capital appreciation over things like current income or volatility risks. So stocks are a common investment holding for long-term growth. An income investment mandates will prioritize current passive income from sources such as dividends, interest, and rent over long-term growth. An environmental, social, and governance mandate and ESG mandates instructs managers to invest in securities that are ethical, socially responsible, and sustainable. So they generally avoid shares of companies that earn their money from things, fossil fuels, guns, and prison labor, while prioritizing ethical and inclusive leadership, environmental protection, and community investments. Now, any of these mandates can be used by individual investors or by fund managers to guide how their money is invested in order to meet short or long-term goals. Now, I mentioned a low investment mandate earlier. Let's quickly explain what low turnover means. Low turnover investment mandate. Now, mutual fund turnover ratio definition. Because when you talk about low turnover, you usually talk about mutual fund low turnover ratio. What's the definition? The turnover ratio of a mutual funds or other funds is a measurement that expresses the percentage of a particular fund's holding that have been replaced, in other words, turned over during the previous year. For example, if a mutual fund invests in, say, 100 different stocks and 50 of them are replaced throughout 1 year, the turnover ratio will be 50%. What a low turnover ratio means. A low turnover ratio indicates a buy and hold strategy for actively managed mutual funds, but it is naturally inherent to passively managed funds, such as index funds and exchange traded funds. In general, and all other things here being equal, of course, folks, a fund with a higher relative turnover ratio will have higher trading cost as measured by expense ratio and higher tax cost than a fund with lower turnover, right? It's normal. The more you trade, the more you sell and buy, the more cost you incur. This is because more trades generally result from more research and analysis, which has its own costs. Trades often have their own transaction fees as well, as I said. So lower turnover generally translates into higher net returns because it usually translates into lower relative costs to manage the mutual funds. Therefore, the cost savings can be passed on to the mutual fund shareholders. The higher tax costs mostly come from capital gains distributions, which are taxes generated from the mutual fund manager selling securities within the portfolio they have gained. These taxes are then passed along to the investor, who in turn has to pay somewhere between 10 and 15% when they file the 1040. Best turnover level based upon the mutual fund type. It's very important to realize that some mutual fund types or categories of funds, such as bonds funds or small cap stock funds, will naturally have high relative turnover up to 100% or more, while other fund types, such as index funds, will have lower relative turnover, less than 10% compared to other fund categories. So generally, you want to, for all types of mutual funds, a low turnover ratio is less than 20% to 30%, and high turnover is above 50%. Research has shown that index funds and most ETFs often have turnover ratios lower than 5%. But the best way to determine ideal turnover for any given mutual fund is to make an apples to apples comparison to other funds in the same category average. For example, if the average small cap stock funds has a turnover ratio of 90%, you may choose to seek small cap funds with turnover significantly below that average mark. So as with many statistical metrics here, if you want to analyze mutual funds, the turnover cannot be used in isolation to determine the worthiness of any given mutual fund, right? You have to look at a variety of metrics. Investors are wise to research and analyze other quantitative measures of the fund. I'll be right back right after this. Don't go anywhere. Welcome back, folks, to another edition of the Sweetie Kiwi Show. We are talking today about an investment mandate and the different intricacies linked to that investment mandate. Now, how do you find out if you need an investment mandate? Mutual funds, exchange traded funds, ETFs, and other pooled assets always have investment mandates. This not only guide how the accounts are managed, they let investors know how their money will be used so they can decide where to put their capital. Individual investors should always have investment mandates. They should also, not always, also, the mandate you decide upon for your own accounts should be consistent with your current situation, goals, and investment policy statement. So drafting an investment policy statement is perhaps one of the most important things you will do as you start your journey to financial independence, because it can help you think long-term in terms of the implications, the visions, the goals you have. And even in the midst of the most catastrophic economic downturn, you can still hold on to your true vision. If a financial manager is in charge of your accounts, they need guidelines in order to do their job correctly. Once they understand how you intend to use your money, your time frame for investing, your level of risk tolerance, and any ethical parameters you may have for where your money is used, they'll be able to guide you towards appropriate investments. Remember that level of risk tolerance is very important. Are you risk averse or a risk taker? Those are things you have to think about. You have to specify it in the mandate. Even if you are investing on your own without a financial advisor, drawing up an investment mandate can help you manage your money and make appropriate decisions, right? Because you have to understand, and a lot of day traders can tell you that investing can be emotional and the stock market is unpredictable. So setting up parameters for where and how you will invest, when you will buy and sell, and what goals you're trying to reach will help you make smart, unbiased, and emotionless decisions. All right. So this is pretty much it, folks. So kind of recap here, let me just give you a quick takeaway. So an investment mandate is just a set of instructions laying out how a pool of assets should be invested, right? So this may include instructions on priorities, goals, risk, and types of funds to either be prioritized or avoided. So mutual funds, ETFs, and other pooled assets always have investment mandates. So if you want to get into one of those, please look for the mandate and read it. Individual investors should also have investment mandates to ensure that their money is invested appropriately. All right, I will see you next time. I appreciate your attention. And if you haven't done so already, please consider subscribing to our channel and turn on the notification bell so you are informed every single time we release a new show. Also, please like this content, share, and comment below. Let us know your experience when it comes to investment, and also whether or not you have an investment mandate yourself, or you've seen one at the fund or ETFs, the mutual fund or ETF that you currently are. All right. Thank you so much for your attention again. I will see you next time. And until then, remember, stay marvelous.